Thanks everyone for showing up and taking time out of your day for this. Been really excited about this webinar. Today, if we go ahead and kind of get things moving, we're going to do a webinar on why infinite banking works. And there's so many different things we could do, and Ray's got a webinars coming up, and we're going to be doing quite a few. But I felt the need to take a step back and focus on the why. The why is very important to me. I think why is very important with almost anything that you do in life. What you're doing is good, but why you're doing it is just as important. And infinite banking, there's a why to it. There's a reason, there's real reasons that it works. It's not some sort of make-believe, mystical system that you can't figure out why this thing works. And I think sometimes we can get lost in the details. Sometimes we get lost in the benefits of infinite banking. There's a lot of benefits, but those benefits themselves are not the fundamental reason that Nelson Nash wrote a book called Becoming Your Own Banker. And they're not the fundamental reason why the system works. So today, we're going to focus on the main things that I could come up with. And this is mainly gleaming from Nelson Nash's book, Becoming Your Own Banker, which I do hope that you read. If you have not read that book, it's fundamental to your understanding of infinite banking. We encourage everyone to read Nelson Nash's book, Becoming Your Own Banker. It's the book that started this whole thing. But there's three areas today that I'm going to focus on as to why infinite banking works. And we're going to dive in. There probably is more than that, but I said, Nate, if I was going to list, here's three things. And three is just a nice even number, okay? Or not even, but just a nice number to go with. It could have probably been 5, could have been 10. But the fundamental core reasons why it works. The first reason we're going to dive into is the fact that you finance everything that you buy. You finance everything that you buy. We're going to discuss that, how that applies to you, and why infinite banking really unlocks potential for your money that most of us had never realized we could do. And it's a new teaching that most of us haven't been taught. And Nelson Nash does a very good job focusing on that in his book, that you really do finance everything that you buy. So you ought to live a certain way. You ought to live a certain way based on this truth. And if you live this way, you'll be successful. And that's one thing infinite banking brings. The second point I want to make is that banking is a process, not a product. This is one of the reasons why Becoming Your Own Banker, the infinite banking concept, works. It's because it's based on a process. You're not hoping that some product is going to save you from living foolishly. Banking is a process, not a product. Banking is a business model. Banking is a business model that you can successfully implement in your own life. And infinite banking allows us to do that. There's also, in that discussion, we're going to talk about where dividend paying whole life insurance comes into play, why it's used in the process of banking. There's fundamental reasons there that you can't miss. And lastly, infinite banking teaches you to make money in a brand new way. I think that's very important. Infinite banking teaches you to make money in a brand new way, in a way that we're not used to. It's another reason why it works. So those three things are what we're going to focus on. Let's go ahead and dive in today. I'm going to pull up a few calculators for our to start us off today. A few calculators, and I'm here to say that you finance everything that you buy, and that comes as a surprise, especially for those of you who are new to the infinite banking world and haven't heard people talk about this fact. But we talk to a lot of people who have paid cash for everything they've ever purchased. Cars, even homes. Someone who's never taken out a loan in their entire life. We've also had individuals who have really borrowed money for practically everything that they've ever done. And I'm here to say that both the guy who pays cash and the guy who uses credit are financing their purchases. You're either going to pay somebody else interest to use their money, or you're going to spend your own money and miss out on any of the interest that money could have earned. And I like to prove that to you kind of in an example here that's very easy to follow along, nothing too crazy. But in this bottom right-hand corner, we have a payment calculator. Oops, I actually put these in the wrong positions to make it as easy as I could to figure out. Let me do this. I wanted this to actually be a future value calculator. This is going to be a future value calculator down here in the bottom right-hand corner. And what I'm going to do is I'm going to assume that you have some money. And let's just say you're going to go out and buy a new car. And I'm going to say that car is going to cost you $25,000. And you're a believer, Dave Ramsey, Susie Orman, oh no man, nothing, right? And so you're out there saving up money in cash, whether that's your checking account or under a mattress, something like that. And you're saving up money to buy a car. And we're going to say the car is going to cost you $25,000. I'm also going to say that you do have it sitting in an account earning some interest. Now, it's almost funny to talk about that today because most of us who have bank accounts are earning literally nothing or as next to nothing, 0.0 something percent on our money. There used to be a day when that's how banks convinced us to deposit money with them. They'd pay us money to leave money there. Nowadays, that's gone by the wayside. I don't know why we still use their accounts, but here we are in the world of banking. That's one of the things we're trying to solve. So I'm going to say it's earning some interest. I'm going to say you have found a magical bank account that's going to earn 4%. There's a reason I use that number, but we're going to pretend that you can find that someplace. And you've built this money up, it's earning some interest, and you're thinking about going and buying a new car. When your banker gives you a call and he says, Nate, I see you've got money in this bank account earning 4%. You've got the $25,000 sitting in the account. I think knowing you, Nate, we've had a relation, knowing you probably are just going to pull that money out to buy a car, pay cash, because you don't like paying anybody interest. But what if I have a different idea for you? What if you left this money here in this account and I use this money as collateral to make you a loan for $25,000? So I'm going to lend you $25,000 instead, and I'm going to charge you 5% interest on this loan. You with me? But he says, hey, Nate, you're going to earn more money in interest on your savings account, earning 4%, than you pay me on this loan for 5%. And he hangs up the phone. Most of us in that situation would be like myself, be like Ray. When we were taught this, we'd call the sucker a liar. Most banks are liars anyway, right? They're just out to sucker us in the first place. And so we think, how on earth could I make a profit having my money earn 4% while I'm paying somebody else 5%? That doesn't seem to compute. But just for illustration purposes, let's go ahead and say we did the deal. We say, all right, man, I trust you. I know it's rare to trust a banker, but I trust you. Let's go ahead and do it. And he says, okay, well, how about how many months would you like to finance your car loan for? A common one today is 60 months. So he says, okay, if we finance $25,000 at 5% over 60 months, your payment is going to be $471.78 per month for 60 months. What we'll do over here is we'll take that same $471.78 and really just multiply it out by 60 months to get a total. Essentially, what this number tells me is that if I wrote a check for $471.78 over a 60-month time frame, the total amount of money I'm going to send to the bank is $28,307. How much did I borrow? I borrowed 25. How much did I pay back? I paid back 28. So if you and I do math the same, then that tells me I paid $25,000 of principal back on this loan, and I paid $3,300 of interest back on this loan. You got it? Now, because I didn't spend my cash, because I kept it in that account and it was able to compound at 4% for 60 months. Remember, I didn't spend it. I didn't liquidate the account to go buy the car. It was able to stay in this savings account earning some interest. And so at the end of 60 months, my account has $30,525 sitting in it, ready to go. Now, how much did I start with? I started with $25,000. How much did I end with? A little over $30,000. So as long as you and I do math the same way, then that means that the bank paid me $5,500 in interest on my savings account, earning 4%, and I paid them only $3,300 to use their money, even though they charged me 5%. When at the very beginning, I called the guy a liar. I said, man, there's no way I'm going to make money borrowing your money at 5 and you're only paying me 4. That doesn't seem to make sense. So what is going on behind the scenes here? What is this? How was I able to borrow at 5 and earn 4 and actually make $2,000 more in interest on this deal? Well, once you take a look behind the scenes, and those of you who have borrowed money for a house or a car, you know this internally. We just need to apply it. That whenever you take out a loan for $25,000 and you're paying it down, what's happening to the balance every single month that you make a payment? It's going down. It goes down, 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 all the way down to 0. And so the 5% interest, yeah, they're charging you, but they're only charging that on the balance. So it's being charged interest on an ever decreasing balance throughout the life of this loan. But those of us who have dealt with compound interest know, like in the savings account, you're earning 4%, but you're earning it on an ever increasing balance. So every single month, that 4% interest is actually earning more for you than it did the month before. So in this scenario, we actually made $2,000 borrowing the bank's money, even though they charged us a higher rate than we were earning, which is huge. There's a couple practical points we want to make out of this. First off, there's a reason I used these interest rates, okay? There's a reason I used 4% and 5%. I used 4% for your savings account really because that's the guaranteed growth inside of a policy that we use in the infinite banking concept. And we can borrow against those policies at 5% or less, depending on the insurance company themselves. So I wanted to mimic what's actually going on inside of a policy here to show you that it's not just magic that I can, like if I tell you that we can make money financing a car or these other things, it's not just magic. There's real math behind it. Remember, we're talking why infinite banking actually works. This is one of the reasons that inside of a policy, if we go and borrow against our policy, we're not actually liquidating the policy cash value. We're using our cash value as collateral and taking a loan from the insurance company. What this does is allows our money to compound the entire time, even when we have it a loan against it. And because this is compounding the entire time, you can actually make a profit every time you use the policy to finance something, as opposed to the old way of doing it. See, before we knew this was true, before infinite banking brought this up, we always thought that paying cash and not paying anybody interest was the best thing we could do with our money. But the question is it really better to liquidate your account over and over throughout life to purchase things, or does it make sense to continually have your money compound? Remember, the average person, before we knew this, we only knew 2 ways to buy it. To buy anything, whether that's a car or anything else in life. We can either borrow somebody else's money or we can pay cash. Both options are kind of a losing option, because if you pay cash for it, just think of this individual who had saved 25 grand, decided to liquidate his savings in order to buy a car. What would happen? Well, he'd be starting back over at ground zero and having to build back money up again. In other words, we call that resetting the compound curve. If you've ever seen a compound interest curve, it starts off pretty slow and then it starts to pick up in later years. It takes time for compound interest to start working on your behalf at a significant clip. Well, the only thing we're taught with money is to essentially liquidate all the money we had an opportunity to earn with, start back over, build it back up again, start back over, build it back up again. And what infinite banking allows us to do, and what Nelson Nash, the truth he brought to us was to say, guys, you really do finance everything that you do, so you ought to live your life in a certain way. And that's what infinite banking allows us to do, or teaches us how to do, is to live as if all of our money has an opportunity cost, that there's opportunity to make money. And we can't just say, hey, paying cash is the best option, especially when you look at the math behind it. So one of the reasons why infinite banking works is because of the fact that you finance everything that you buy. You either pay cash and lose interest that you could have earned, or you borrow somebody else's money and pay them interest. There's no way around it. So stop, living what we call like a poor mentality and avoiding all interest. Make sure you're setting yourself up in a way that you can profit from the use of your money the way the banks do, by leveraging money, not just letting it sit, build up and liquidate, build up and liquidate. It gets us into the future stages of the compound interest curve faster. This also says that maybe we ought to treat our money like a bank treats it. In other words, whenever you borrow money from your policy or whenever you spend money, even from your checking account, we have a lot of clients and who have done this as well. Hey, when we spend money, we want to recapture it because our money has real value, real cost. And just because I have the money doesn't mean that if I spend it, I should just let it dangle out there and leave it alone and just spend money until I'm broke. So remember, banking is a process, not a product. And what Nelson Nash said about that was very important. So this is one of the principles of infinite banking that you have to understand if you want to know why it works. Number 2 today that we're going to dive into is that banking is a process, not a product. The banking model, the business model of a bank actually works, people. If you can't tell, they make good money. We've just never been told how we can model the banking business in our own life. And that's what Nelson Nash really said. Nelson Nash didn't write a book, and this whole concept is not about how to buy life insurance the right way. That's not the reason. You have to have a desire to actually become your own banker. And what that entails is controlling a pool of capital that profits you, not somebody else. That's really all this concept is about. Nelson Nash wrote a book not to say life insurance is great. He says, here's how you can use it to become your own banker, which means you ought to get familiar with what the banking business is if you're going to be a banker. And so for most of us, this is all we've known about banking. When we go out in the world, we earn money, and that money has to be put someplace. Money has to reside somewhere. It can reside in the mattress, it can reside in a bank account, it can reside in a 401k, it can reside anywhere. But for most of us, the central hub for all of our financial dealings is a bank account, a checking account. Direct deposit straight from the paycheck. We always flow it into the bank. And so essentially, we're going to say you have some money sitting in the bank. I don't care how much money you have. Let's just say you have $10,000, a nice, easy, round number. That's how much you have deposited at a bank right now. And I ask people this question. And it's funny that it's almost like a leading question, as if I'm trying to get somewhere, but I'm actually curious to know whenever I'm talking to some of my clients and people who are looking into this. I ask them, okay, you have X amount of money sitting in cash at the bank. Are they paying you any interest? That used to not be a funny question. That used to just be a thing. Now people laugh when I say it. They laugh at me and they think I'm joking. And I'm like, no, I really wanted to know. I'm curious in real life with your own situation. Are your deposits at the bank paying interest? And half the time it's just essentially, no, they're not at all. Other times, it's so small, I couldn't even tell you. So we have to come up with something. And I found some bank savings accounts and things like that you might be able to get 1% interest on. So I'm going to give everyone the benefit of the doubt and say, you didn't laugh at me. You say, yeah, I'm earning like 1%. Let's just start there. So we have $10,000 in a bank and it's earning 1% interest. The question is, if we're going to get in the banking business, how should we see this deposit? How should we see this deposit? Well, if I'm in the banking shoes, and this guy just brings in $10,000 and I've agreed to pay them 1%, this money is actually a liability to me. The money that's sitting in the vault has a real cost. In this guy's case, it's 1%. If he leaves the money in the vault, they're going to go broke. So this $10,000 is actually a liability to the bank. It's a loan to a bank. I don't think people really understand how the banking business works. But in reality, every time you make a deposit to a bank, into your checking account, your savings account, whatever it is, you have legally made a loan to the bank. It's legally what you've done. And so it's a liability to them. They have to then take the money and do something with it in order to stay in business. Remember, banks don't let any money sit. They just tell you to do that. Banks say, hey, come let your money sit with me. I'll treat you real nice. And then they take that money and they go put it to work, not for your benefit. but for the owners of the bank. This is fundamental. So they take your money, they pool it together with somebody else's money, and they say, hey, we've got enough money now to go find somebody who needs to buy a house and lend them the money to do it. So they take our money, pool it together with somebody else, and they lend it to a guy who wants to buy a house, and they charge them 4% interest on this loan. And this homeowner now has to make payments back to the bank. So the bank gets all the money back and makes a profit on that money. Now, remember, banks don't let money sit. Individuals, you and me, are the only financial entity in the world that is suggested to let money sit. If you ask any business, sitting money is costing them opportunity. So banks say, well, this guy's making all these payments back to us. We're starting to get some more money back. What should we do with this money that's coming back in? Well, why don't we take it and find someone who wants to buy a car and lend them some money, charge them some interest. So they go out and find a guy who wants to buy a car, charge them 5% interest, and he starts making payments back to the bank. Now, I want to stop here for a moment. The bank's made 2 loans. It seems like they're doing pretty good because they're buying our money at 1% over here. And then they're selling money to the homeowner at 4%, and then recycling his money to go sell it again to the car guy at 5%. Man, how much money does the bank actually have to put into the gig to run their business? It looks like nothing. They just use everyone else's money. More on that in a second. They're just moving money around. Remember, banks are in the money business in the same way that a grocery store is in the food business, or a gas station's in the gasoline business. Essentially, all they do is buy money at one price from us and then sell it back to other people, even ourselves, sell our own money back to us at a higher price. But it's not a bad business model to be in. They haven't put any money in the gig. Seems like they're doing okay. Well, we can keep on going with this, a couple more. Let's say it's like a student loan or maybe a house remodel project or some miscellaneous loan. They're charging us 6% for that. He's got to pay it back. And lastly, maybe there's like a line of credit or something like that that they send out, charging him 8%, and he's going to have to pay it back. So essentially, all the bank is doing is taking our money and moving it. And this is what I like to call the problem. This is the problem with the banking situation that we're in. This is what we're actually trying to produce a solution for. Remember, this whole webinar is about why infinite banking works. When we look at this system, we say, man, we're getting robbed. We're getting shanghaied out here, man. This is insane. Take a look at what's actually going on. If I take the 4% they made on the house and subtract out the 1% they paid us, that's 3%. 5 minus 1% is 4%. 6 minus 1 is 5. And 8 minus 1 is 7. So that's 7 and 12. That's 19% right here. They made 19%. And they paid us 1% of that. The question still remains, whose money started this whole process? Whose money instigated everything that happened? And the obvious answer is you. It was your money that started this process. And even though they're using your money to do everything they want to do as a bank, they just don't send money back to you in a thank you for it, or at least they do very little. We are getting killed as depositors. So one of the biggest problems is that the way the banking world is stacked up against us, it really is difficult to get ahead, because even though it's our money as depositors that's out working in the economy, we're not receiving our due share of the profit. But not only that, many of you on the call today are also homeowners. And the chances that you paid cash for a home are probably pretty slim. So that means you borrowed money from somebody, probably from a bank. Who's getting interest on that? Well, it's not you, somebody else. And there's a lot of interest on a mortgage being gone. So not only are we getting killed as a depositor, but we're also the borrowers. Many of us have car loans today or have had car loans, paying interest and losing money. We've got student debt. We've got remodeling debt. We've got credit card debt. We've got lines of credit. We've got all these sorts of things that we owe to the bank, which all this points to the fact that, hey, if there was a way to break free from this system, would you want to know? Because if there was a way to do this differently, you might be able to make a lot more money without changing anything about your life, without changing anything you're doing financially at its core, just changing how you're doing banking. And that's really what infinite banking is all about. That's why it works, is because this business model actually works. The banking model works. We just have to mimic it. So the real question is, and for those of you who are familiar with what we're doing, we suggest that you use a dividend paying whole life insurance policy to replace the bank. We get rid of this guy and we put your policy in the middle. We start making deposits to the policy and then use our policy and the cash values that it builds to do all these other things that we want to do. The question you should be asking yourself in all of this at this moment is why? Why? And this is really the whole point of this webinar today. I don't want you to be curious as to why policies are used to build your own bank. It has nothing to do with the perks. It has nothing to do with the rate of return. It has nothing to do with the tax-free nature of the growth. All of those things are great, but that is not why a policy is used. It goes deeper, much, much deeper than that. There's really two things I like to talk about in this scenario. Let me take a drink. There's really two things I like to talk about. One is more theoretical. One is more purely analytical. It always surprises me that we're not told what banks do with money. But amazingly, banks purchase more whole life insurance than any other entity, group, individual in the world. Bank of America, and Wells Fargo each have over $20 billion in life insurance, cash values. In fact, they have so much, they even get to call it their own name. It's called BOLI, or bank-owned life insurance, what that stands for. In other words, and this is enough for some people, this is enough why for some people. In other words, banks are already doing exactly what we suggest you do with the same tool that we suggest you use as well. They're out there taking our money and the profits our money produces and using that to fund policies to make a profit. Honestly, that's enough for me. I know the banks aren't stupid. Or if they are stupid, they got really rich by accident or something, because they're the ones with all the money. So I'd rather be stupid and have some money than be poor and just broke. So the bank's already doing it. But here's what I wanted to share. The real reason why policies are used is very specific. And the reason that it's used is because banks and life insurance companies are exactly the same thing. This is what's going on behind the scenes. This is worth your entire time on the call. Let me pull this up really quick. Banks and insurance companies are the same thing. The only difference is the name out front. We have a bank on one side and a mutual life insurance company. Mutual life insurance company on the other side. Some people may not be familiar with that term on this call. So just really briefly, a mutual life insurance company is a company that is owned by its policyholders. There's two types of insurance companies. There's stock companies and mutual companies. A stock-held life insurance company is a company that's owned by stockholders. In other words, you can go to you can go to Wall Street and buy stock in these companies, whether that's AIG, MetLife, things like that. They have stocks that you can own, which means that in the insurance policies that they sell, they're trying to make money off of their customers to benefit their stockholders, right? Just like any other business. They're making money off of their customers to benefit their stockholders. Well, in a mutual life insurance company, there are no stockholders. So at the end of the year, when profits come, who receives the profits? In a typical business, the stockholder receives the profits that the business generates. In a mutual life insurance company, where there are no stockholders, the owners are the policy holders, in which case at the end of every year, the policy holders participate in the profits of the company. So that's the difference. And there's a reason we use mutual life insurance companies exclusively for infinite banking. But just to share with you the business model, it's very simple, guys. Don't overthink this. In a bank, nothing starts unless somebody makes a deposit. So in a bank, they need other people's money. So it all starts with a deposit. Somebody has to go deposit money. Well, in a mutual life insurance company, where does everything start? It starts with people depositing money. They need someone to put money in. Or in this case, it's actually, the technical term is a premium. That's how you deposit money at the life insurance company. In a bank, it's just called an account deposit. In the life insurance company, it's the premium, but they're the same transaction where he's sending money and putting it in to an account at the bank or a life insurance policy through deposits. Now, to entice us to put money there, the bank pays us some interest. You got it? Now, once again, some people laugh when I say that. Try not to laugh. I know it's pretty rare these days. At least that's how it used to be. Now, I guess it's just built into the system. They're not even paying us interest, and yet somehow, for some reason, we're still putting money there. Who's not the smartest here? I think it's probably us. The banks seem to be doing okay. But in other words, to entice us to put money there, they pay us interest. Well, how does a mutual life insurance company entice people to put money inside the policies? Well, they pay them interest. They pay us interest. That's in the form of guaranteed cash value growth. Interest, what we would call that in a more common circle. So they're each paying us interest to deposit money there. How are they able to pay us interest? How is a bank able to pay you interest? Well, they've got to take your deposit and do something with it, right? So what does a bank do? A bank lends money. It has to make loans. So they take our deposit, they make loans with it, and that they use some of that money to pay us interest. Well, how does a mutual life insurance company make money? What do they do with it once they receive it? Well, they make loans. They lend money through the form of bonds, mortgages, policy loans. They're just a big bank. That's all they do. This transaction produces a profit. Remember, just like we had showed on that previous page for the bank, we make a deposit, they pay us a little bit of interest, they take the money, they lend it to other people, they lend it at a higher rate than they're paying us, and so there's a profit that's produced. Who gets the profit at a bank? It's certainly not you and me. Don't need me to tell you that. Whoever is the owner or the stockholders of a bank receive the profits. Well, the mutual life insurance company is doing the same thing. They make a profit at the end of the year. More money came in than what's needed to pay the bills and to pay us our guaranteed cash value growth that they promised. What are they going to do with that profit? Well, there's no stockholders to send it to like a normal business. There's no Wall Street, trading guys to send money to. Where do they send the money? They send it to the policyholders. So do you see that when you plug in as an owner of a mutual life insurance company, you've essentially became an owner of a bank? That's really what you've done. And that is why you are going to profit like an owner, not as a depositor. So whenever I say a mutual life, and the policies that you get for infinite banking may produce a 4-5% growth, rate of return, something like that. You should really be asking yourself, how do they do that? Why? Why can the business be the same as a bank, and yet my deposits at the bank earn 1%, but in my policy I earn much more than that? What's behind the scenes going on? Well, all of that is what is rightfully yours on your money as an owner, as opposed to a depositor. So you can start to see that if we go back and we say this is not a bank, but this is your policy, is all this interest going to be earned, given to somebody else, or is it going to be given back to you? Well, it's going to come back to you. And what if we were able to accelerate it by taking over all these debts that we have as individuals, so we're no longer losing interest to them and instead able to pay you back with that same interest? Have we not solved the banking equation for you in a way that guarantees you to be successful? If you can make what you're supposed to be making here on your deposits through becoming an owner instead of just a customer of a bank, and then use that money to recapture all the interest that ekes out the door, can't you see that there's a lot of money to be made? This is the fundamental principle of infinite banking at its core. You got it? And in Nelson Nash's book, he mentioned one thing. I'm not going to spend a ton of time on it, but there's this word out there. And those of you who have read Nelson Nash, bonus brownie points if you can remember what he talked about with cogeneration. Cogeneration is a concept in electrical energy output. And he used an example out there. I like to use a different one, with a solar energy. For those of you who may have, solar energy at your home, like I know Ray, who is the founder of Living Wealth, and him and his family, they went out and bought a new house and put solar powered energy in it. And in the wintertime, the solar panels are actually producing more energy than what his household needs to power the house. You got it? And it's producing more than what it needs. So he's got this extra energy. What can you do with this extra energy? Well, I mean, it would be rather foolish, I think, to go out and try to sell that energy to your next door neighbor, or to start erecting power lines and try to build your own energy company. What would make more sense? Well, why don't you just plug into the system that already exists and just sell the energy back to the energy companies that are there, and just plug in to a system that already exists and make money that way? So that's exactly what you do. He gets a credit during the winter when he's not using the air conditioner and things like that from that energy. And that's exactly what we're doing with policies. We are plugging into a system that already exists, that we don't have to do any work to start, but we get to profit from it in a way that, doing it things the normal way, we would just be wasting money through the bank. That's essentially our problem. So remember, 3 things. First off, why things work. You finance everything that you buy. So stop getting yourself off the compound interest curve. You can do that through the loan provision of a policy. Number 2, banking is a process, not a product. There's a reason why. The reason why banking sucks right now, and that you've been a bad banker up to this point, is because there's other people who are constantly making money off of you. We have to axe that. We have to cut that out and start making money ourselves. Banking is a process, it's not a product, and there's a real reason why dividend paying whole life insurance is used. And lastly, what I want to share, and I'll pull this up, is that what infinite banking allows us to do, and the reason why it's so different, is that we're able to make money in a way that we've never thought we can make money for, and in a brand new way. And this is what really changes the paradigm once you catch it, is that we're actually making money differently than the world teaches. So for those of you who have been saving money, have a financial plan or whatever it is, the only options that most of us are given to use our money in are essentially, this is the conversation. Hey, Joe Blow, you need to put your money in this account, let it sit there for the next 30, 40 years. I'll manage it for you for a small fee. And, here's how much money we hope to have at that time if market, turns out well, and so forth. And essentially the only way we've learned to have our money work and produce profit is by letting it sit someplace. Okay. That's all we've ever been taught, is money sitting. But remember, we're getting into the banking business. The business is all about money moving. It's a different world. So we're going to make money in a different way. This is also one of the reasons why you won't see us at Living Wealth compare the growth of a policy to some sort of other asset. There's a reason why. We don't compare it, not because there's no comparison that could be made, but because that's not the goal of banking, just to buy a policy and let money sit. That's what you do when you invest money, but that's not what you do when you do banking. Banking is about money moving. So I'd like to show you in this example exactly how we see it. But I got to lay the foundation, just so it's kind of a lot of numbers here. So I just wanted to tell you briefly where everything's coming from. I don't want to spend a ton of time because we have this type of example all over the place where that's the sole goal of the webinar, is to go over it. And today I'm just going to do it kind of quickly just to share some concept. Making money in a way we're not used to making. So in this example, we have a guy who does start a policy. He's 50 years old, and you can see how we fund it right here. So this is his premium deposit right here. This is how much money he's paying in premium. We put in $30,000 the first year and then $20,000 every year after that through the 7th year. And then we stopped funding the policy. I think a lot of people, when they see examples like this, you really need to back up and just listen to my words really quick. Because I talk to a lot of people who overthink what we're doing here, dramatically overthink it. One of the things I wanted to mention is we don't suggest that you stop funding your policy. When would you want to stop building wealth? When would you want to say, I'm done? When would you want to put a cap on how much money your banking system can make? Because remember, if we kept paying the premiums, what would happen in the cash value of your policy? They would keep going up dramatically faster. So this is not a suggestion or anywhere close to it. If you're a client with ours, the chances that we've ever told you to focus on a short premium payment period are pretty slim. There's certain scenarios where it makes sense, but for the most part, if you just look at my own life, I don't ever plan on stopping my premium. That's how I get more money in my bank to profit me more and more. So the reason we stopped funding it was actually just so we could isolate the loans that you're taking from the policy and the repayments you're sending to show you that you can actually make a profit. And that's what I want to do today too. So don't look too much into that. But we did stop paying the premium after year 7 and just had the policy pay for itself at that point. We weren't sending in any more money. And in this example, all we do is buy cars. It's a very common transaction. We're all used to buying cars. That's why we chose that as our foundation. And in this case, we buy essentially one car. We spend $50,000 on it once every 5 years. And remember, banking is a process. So whenever you take a policy loan to go buy a car, are they going to put you into an amortization schedule and require payments from you? The answer is no. To get a policy loan, all you need to do is give them a call. You say, hey, can you send me $50,000 out of my cash value? They say, sure. Where do you want us to send it? You go ahead and send me a check or deposit right in my bank account, whatever you want. And the next, few business days, there it is, sitting in your account. They have no idea if you're going to repay any of it. They don't care, because here's what they know. They know you're going to die someday. You're not going to live forever. And if you were to pass away while you have a loan outstanding, then they'll just take off the loan balance from the death benefit and send the rest. So they're going to get their money back. It's just either you're going to send it while you're living or they're going to get it back when you die. They don't care. So why on earth would you pay you back if no one's forcing you to? Because that's part of the process of banking. If all we did was pull money out and never paid ourselves back a dime, then what's going to happen whenever you need to buy another car? You're going to be broke. You're going to have to go borrow it back from Wells Fargo or Bank of America. We want to get rid of those guys. So essentially what I'm saying is we're going to take this $50,000 loan to buy a car, and we're going to pay us back in a similar way that we would have paid anybody else back. This is the system that you enter in when you decide to do infinite banking. You decide, I'm going to treat myself and my money just like I would treat the bank's money. That's how you produce a profitable bank. So on a $50,000 car loan, over 60 months, the payment is going to be about $1,000 a month, approximately. So that's what you see here. We start paying it back $1,000 a month for 60 months inside of this policy. That's what we do here. We decided that we didn't even have to tell the insurance company that's what we wanted to do. We just started sending them $1,000 a month. You see, we're in total control of this situation. And we do that for this very first car. And what I wanted to do, because the goal of this is not to describe this in a lot of detail, I want to actually scroll down a little bit. And I'm doing that on purpose because there's something I want to say. There's something I want to use this to do. Remember, this third point is not you can make money buying cars. You can, but this third point I want to make is that infinite banking teaches you how to make money in a brand new way, in a way that we're not used to. And I'd like to get to the period of time where we don't have any more premiums, just so the numbers are clear and clean. We know what's going on. And what I'm trying to get at here is, so after the first car, we had built up a cash value of $159,000 at that time. And what's going on here in this second car is we go out We borrow more money to go buy our next car. We assume maybe the first car is yours and the next one is your spouse's car or something like that. And so we go out and we buy another car using this cash value, paying it back the same way that we paid it back the first time, $1,000 a month for 60 months. The only difference is now, there's no premium going in. It's just these loan repayments. And what I'm trying to say is most of you have borrowed money to buy a car before. Most of you on this call have done that at least once. There may be some who have paid cash for every car. Most of us have taken at least one car loan out or borrowed money for some purpose. And every time, let's say if this was a typical car loan and then there was $1,000 payment, who's going to get all the money on that car loan, on those payments? It's not you. That money leaves your account and is now sitting in somebody else's account, typically the car loan finance company, whether that's Ford Motor Credit or Bank of America or whoever it is. So we are used to borrowing money, and then we have this payment that they've locked us into, and every single time we make that payment, our bank account has less money, which means we are poorer than the day before. Does that make sense? I hope it makes sense. That every time you make a payment, you are now more poor than you were the day before, which is unfortunate, right? And we're used to that. That's one of the reasons why we don't like borrowing money from a bank. We don't like paying interest, but we don't like paying anything. We don't like making we don't like making any payment at all, because every single time that money leaves your account, that money is gone forever and will never earn a dime for you. But let me backtrack and say, well, okay, we did take a loan out from this policy and we bought a car, and we're going to pay it back. We're going to pay it back of our own free will, out of our own, desire to do so as a competent banker. However, in this scenario, you are not just a borrower, you also own the bank. You own the bank where the money's coming back into. So let me show you what's going on. Let's just take year 9 as an example. That's right here, year 9 of this guy's system. And you'll notice the car loan repayments were $12,000 for a year. That's just the annualized $1,000 a month. But we live monthly. So what's actually going on is we are sending $1,000 every month in year 9. That's the only transaction that's occurring in year 9, is we are sending $1,000 a month back to this policy to repay the car loan that we took out for $50,000 the year before. And so every month we're putting in $1,000. But take a look at what happened to this cash value in year 9. In year 8, we had $126,000. And by year 9, we had $145,000. That's a total of almost $19,000 just in year 9. That's how much this cash value increased. $19,000. Well, if you divide that by 12, in other words, if you take a monthly figure for that, that means this is literally what's happening. Every single time you make a payment, $1,000 payment every single month, that you're actually going to grow by over $1,500 every month. In other words, you took $1,000. It feels like a car payment still, doesn't it? It feels like what it used to feel like. We're sending money out of our bank account at a clip of $1,000 a month. But then we have to remember, hey, that money didn't go off into the netherland, to the void, into the ether, to disappear to somebody else's account. What happened with that money? Well, this thing that feels like a car payment where money left our bank account has now produced $1,500 that same month in capital that we can use. In other words, a transaction that used to cause a $1,000 expense, $1,000 where you are out all of that money, you have nothing to show for it. You have $1,000 less and there's nothing else going on. Now that same transaction has produced $1,500 that you can actually use. What I'm trying to isolate here is to say we are not used to making money in this way. We are not used to making money as an owner of a bank. We're not used to making money while it's moving, while it's out working and buying a car. We're used to losing money for these types of transactions, buying depreciating assets like a car that's going to depreciate to zero. And we're just out the money. It's an expense. Over the course of this one car purchase, take a look at this. We went from having $159,000 to $207,000. That's right at a $48,000 increase over that time. Well, what caused that increase? Remember, only really two transactions occurred. We took out a $50,000 loan and we repaid it with $60,000 in loan repayment. That's what we did between year 7 and year 12. That's all we did. So we took out 50,000. That's a minus sign here. This is third grade arithmetic. Don't think too hard on it. We took out 50 and we put back in 60, right? That's all we did. We took out 50, we put back in 60. If this was just a bank account, a checking account, building the banking system someplace else, how much more money should we have in our account than what we started? If you take a $50,000 withdrawal and you make a deposit for $60,000, well, that says that there should be $10,000 more in this account. Or in our case, we should go from having $159,000 to having $169,000. That's really where we should be. But you'll notice we're not at 169. We're at 207. That's $38,000 difference between what we should have and what we do have. Where did that money come from? Why is it there? I'm telling you, that money is going to be paid to somebody. Whoever the owner of the bank is going to receive that money. It's either going to be you through your dividend-paying whole life policy at a mutual company where you are the owner, or it's going to be whoever owns the bank at your local branch office, whatever it is. That money did not appear magically because of this policy out of a vacuum. That appeared because of the system you have started, because you have plugged in to the banking world as an owner and not a depositor, and you should profit that way. So when we talk about infinite banking, the whole discussion is really about how to make more money in this new way. That's all we're talking about. How can I make my banking business better so that I can make more money in areas that I used to make nothing in? That could be in buying a car. That could be going on vacation. That could be giving. That could be property tax. It could be income tax. It could be making real estate investments. It could be buying gold and silver. It could be buying Bitcoin. We could go on and on about what we do with policies, but all we're trying to teach you how to do is that there is a different way to buy things and to fund things that you want to do. And it's called becoming your own banker. And it allows you as an owner of to profit as an owner of a bank, not just how you buy the things that you buy. That's really all that we're talking about here. And over a period of time, it gets rather large. In this guy's example, he buys 5 cars, every car for $50,000. He was 50 to start with, buys 5 cars every 5 years. I started in year 3. At age 73, he bought his last $50,000 car. We actually have to go down to page 2 to kind of wrap it up. At age 77, he had finished paying off his last car for $445,000 of cash value. That's how much money has been built up in his account over this time. Let me make it a little bit smaller so I can scroll down. So we can isolate in this example right here. The guy's going to buy cars no matter what. We can isolate what his profit was for transitioning to become an owner of the bank as opposed to just a depositor somewhere else, making money in a brand new way. And we can isolate that by looking at the bottom is the accounting of all that's happened. All the money that's gone out of your pocket into this policy, which is really just another one of your pockets now. That's really how we see it, just moving money from one pocket to another. But we've moved money out of one pocket into this at a clip of $450,000 over 27 years. That's what we've done. To figure out how you get that money, we paid $150,000 in premiums for the first 7 years. Remember, we put $30,000 in year 1, and then we put in $20,000 a year from years 2 through 7, or for the next 6 years. That totals $150,000 of premium. That's how much we did. That's what we call capitalizing the system. That's how much money we put in to build the bank out of our pocket. We also bought 5 cars. How much did we pay back to the to the policy every time we financed the car? Paid it back with $60,000. So 5 cars times $60,000 means we paid back a total of $300,000 in loan repayments. That's the total amount of money that hit this policy in deposits. That's what we like to think of. This is the deposits into the policy, just like you can make deposits anywhere else. We also had to buy 5 cars, 50 grand a piece. That's $250,000 we took out to buy those cars. So our bank account, if we had had just a bank sitting at an account and we just used cash to pay for cars for the rest of our life, I mean, he did okay following the rules, building the system up. I mean, he's got $200,000 sitting in his bank account is what he could have done, and felt okay. But when we compare what he would have had at a bank to what he has in his policy, we know he's almost $250,000 short. So where did this money come from? If you ask yourself, why does infinite banking work? Why did we make so much money owning the bank? Once again, it's all based on who is the owner in the situation. Who would have made that $250,000 profit if you had just done this at a bank account? It's not you. It's the shareholders of that bank, the stockholders in that bank. All we did was change who owns the bank. We started making money in a brand new way. Now we can get way more complicated than this. Show a lot of different innovative ideas. That's what living wealth is all about: is pushing the limits of this concept to make more and more money from it. But just to take a step back and say, guys, there's 3 real reasons why this makes sense. Our principles at work here that produce the infinite banking concept, the becoming your own banker concept. Number 1 is you finance everything that you buy. Most of us are missing out on a lot of interest by how we buy things. We need to be paying ourselves back with interest for the things that we buy. If we do so, you will be successful. You always have to remember that banking is a process, not a product. We are mimicking the banking business. We're going to make money like the banks do it. And we use dividend paying whole life for a couple of reasons. Number 1, the banks use it. And number 2, it's the only tool that we know of that we can plug in as an owner of a bank and profit the way that we should be profiting on our money to begin with. And lastly, the reason it works is because it frees us up to make money in a brand new way. And with that, I will take some questions. I do know there's been a couple questions posted. A couple questions. Let's see. First question is, if we are paying the insurance company back $60,000 versus $50,000, how does it get back to our cash value? Great question, Frank. First off, it does it in 2 ways. First off, if you can remember that initial set of calculators that that I had listed up, it's true that some of that 60,000 or that extra 10,000 of interest is really what we're focusing on there. The extra 10,000 of interest that we pay, some of that is actually just going back to the insurance company. Remember, we posted our cash value as collateral and they sent us a check. Essentially, that loan is an interest-only loan for life. And so some of the interest of that 60,000 we actually paid back to the insurance company. So how did we get that back? Well, we got it back because they guaranteed that our money would continue to compound with interest the entire time. So we will always, just like you saw on those calculators, just math also applies inside the policy. That same math applies, that we're going to pay them interest on the policy loan while they, on an ever decreasing balance, in other words, we're paying less and less interest over time, while they are going to credit our cash values with more and more interest over time. So that's a big chunk of it. It is true, though, that we did pay back a little bit of extra interest, which is another concept. And so some of that 60,000 was not actually pure policy loan interest. It was money that we sent back above and beyond that, which is a whole new can of worms. I'm not going to get too much into that, but that extra interest does go straight back into your policies through the use of your paid-up additions rider and boost your cash values overall. So there's two things going on there. One of them is just, the principle that we talked about at the very beginning. The other one is we did pay a little extra interest, and mainly we did that because we like round numbers, to be honest with you. If the loan repayment was like $957.34, that just makes for a pretty lousy example. So we just say, let's pay it back at $1,000 a month. So we are going to pay a little more back than what it's going to take to pay off the loan. But some of that is just going to go in essentially through our paid-up additions rider. We have a question from Brian as well. He says, can I get a policy if we have health issues that preclude them from getting a regular life insurance policy? Yeah, that's a great question, Brian. If you are uninsurable due to health issues, you may not be able to buy a policy on your own life with you as the insured, but that does not stop you from practicing infinite banking by buying a policy with somebody else as the insured. And so, I mean, that's what most people do. Like even Ray, if you've heard his testimony, he's the founder of Living Well. He's had leukemia diagnosis since 2001, and that's when he became uninsurable. That's 19 years ago. That's really right when he's learned about infinite banking, unfortunately, too. But that hasn't stopped him from practicing IBC. He owns like over 100 policies now. He just buys policies on anybody he can get approved with an insurable interest. So normally there's somebody in your life that would be happy to offer their insurability to you, and you can be an owner of a policy with a different insured. What is the recommended monthly premium to make this policy effective? I mean, there's not exactly just one overarching goal. I mean, the amount of premium we typically try to shoot everyone to hit is about $400 a month or about $5,000 a year. And if things are so tight that you don't have that amount of room in your financial picture, it may not be time. May not be time to start. And you ask, can you get a policy for someone in another country? It is possible, though honestly, we're airing this webinar during COVID-19, and it is becoming a little bit more difficult to do that just right now. It's becoming more difficult than it usually is. Great question. Any other questions before we close it down, guys? I'll take that as a no. Well, thank you guys so much for joining me. I hope it was beneficial. I hope it was good just to get back to the basics, the foundation of what we're doing. That's really what we wanted to focus on today. If you have any other questions or want to talk to me a little bit further, feel free to shoot me an email with your questions. You can do that at nate@livingwealth.com, nate@livingwealth.com. I would be happy to help answer your questions. But with that said, we're going to close down this. Thank you so much for joining. We will, Ray's doing one next week. We'll have plenty more to come in the weeks to come. But thank you guys so much. Have a great day.